Do you know in football, there is a buyback when a footballer who is being sold to another club has in his or her contract the option for the club that owns him or her to be able to buy back in the future? Well, this is the financial market and we'll be looking at the same term. Welcome to the Financial Market Examiner YouTube channel, where you can learn about Forex, crypto, and the stock market. Well, on this channel today, we'll learn about Share Buyback. What is Share Buyback? This is the reacquisition by a company of its own shares. Share Buyback is also known as stock buyback or share repurchase. It represents an alternate and more flexible way of returning money to shareholders. When used in coordination with increased corporate leverage, buybacks can increase share prices. In most countries, a corporation can repurchase its own stock by distributing cash to existing shareholders in exchange for a fraction of the company's outstanding equity. That is, cash is exchanged for a reduction in the number of shares outstanding. The company either retires the repurchased shares or keeps them as treasury stocks available for reinsurance. Why Share Buyback? There are three major reasons for Share Buyback. They are: 1. It helps companies consolidate ownership. 2. When there is market pessimism, companies use buybacks to increase equity value. 3. Buybacks can make companies look more financially healthy, thereby attracting investors. Methods of buyback. 1. Open markets. In this method, the firm will announce that it will repurchase some shares in the open market from time to time as market conditions dictate, and maintains the options of deciding whether, when, and how much to repurchase. Open market repurchases can span months or even years. There are, however, daily buyback limits which restrict the amount of stocks that can be bought over a particular time interval, again ranging from months to even years. 2. Accelerated share repurchase. An accelerated share repurchase is a share buyback strategy where a company repurchases a large chunk of its publicly traded equity shares. Companies rely on specialized investment banks to effectuate the transaction. In a typical ASR transaction, the company delivers the cash up front to the investment bank and enters into a forward contract to have its share delivered at specific future dates, adhering to regulations, and subsequently the bank borrows shares of the company and delivers those shares back to the company. Companies often engage in accelerated share repurchase programs if they have certain convictions about the intrinsic valuation of the company, or if they have commitments of capital returns to shareholders. 3. Fixed price tender. This offers specifics in advance a single purchase price, the number of shares sought, and the duration of the offer with public disclosure required. The offer may be made conditional upon receiving tenders of a minimum numbers of shares, and it may permit withdrawal of tendered shares prior to offer expiration dates. Shareholders decide whether or not to participate, and if so, the number of shares to tender to the firm at a specific price. Frequently, officers and directors are precluded from participating in tender offers. If the number of shares tendered exceeds the number sought, then the company purchases less than all shares tendered at the purchase price on a pro rata basis to all who tendered at the purchase price. If the number of shares tendered is below the number sought, the company may choose to extend the offer's expiration date. 4. Dutch auction. This offer specifies a price range within which the share will ultimately be purchased. Shareholders are invited to tender their stocks if they desire, at any price within the stated range. The firm then complies these responses, creating a demand call for the stock. The purchase price is the lowest price that allows the firm to buy the number of shares sought in the offer, and the firm pays the price to all investors who tendered at below that price. And if the number of shares tendered exceeds the number sought, then the company purchases less than all shares tendered at below the purchase price on a pro rata basis, or will tender at the purchase price. If too few shares are tendered, then the firm either cancels the offer provided it had been made conditional on a minimum acceptance, or it buys back all tendered shares at the maximum price. Types of share buyback. 1. Selective buyback. A selective buyback is one in which identical offers are not made to either shareholder. For example, if offers are made to only some of the shareholders in the company, 2. Employee share scheme buyback. In an employee share scheme buyback, a company may also buy shares held by or for employees or salary directors of the company or a related company. 3. On-market buyback. A listed company may also buy back its shares on market trading on the stock exchange following the pricing of an ordinary resolution if over the 10-12 limits. 4. Minimum holding buyback. A listed company may also buy unmarketable parcels of shares from shareholders. This does not require a resolution, but the purchased shares must still be cancelled. Issues with buyback. A stock buyback affects a company's credit rating if it borrows money to repurchase the shares. Many companies finance stock buyback because the loan interest is tax deductible. However, debt obligations drain cash reserves, which are frequently needed when economic winds shift against a company. For this reason, credit reporting agencies view such finance stock buybacks negatively. They do not see boosting EPS or capitalizing or undervalued shares as a justification for taking on debt. A downgrade in credit rating often follows a maneuver. We've come to the end of the video for today. Note that this video is not for financial advice but for educational purposes only. Kindly subscribe, share, and like after watching. Thanks.